The Federal Reserve may have paused its hiking campaign this month, but that doesn't mean it's the last hike. Jay Powell signaling rates will stay higher for longer, and some investors are pricing in another hike before the year's end. Joining me now is Cresset Capital Chief Investment Officer and founding partner Jack Ablin. Jack, thanks for coming by today.
Thanks for the invitation.
So just to give readers or viewers some context, if they're not familiar with it, Cresset Capital is an independent financial advisory firm, highly ranked by Barron's. You guys manage a little over $40 billion. Let's start with the higher for longer concept. You've been looking at a very specific consequence of that, which is that companies that have been borrowing at ultra low rates are over the coming years going to have to pay a lot more, and that's not going to be easy for some of them.
That's it. And I originally thought this was going to be a 2023 firestorm. What I realized when I started getting into these maturity schedules, it's really more of a gale force wind for the next few years. So if you look, for example, at investment grade borrowers, we have about $1.4 trillion of maturities coming due over the next 3 or 4 years. That's going to be refinanced at rates anywhere between 2 to perhaps even 2.5% higher than current coupon. And so part of the thought was, well, if rates could come down between now and then, that burden may not be as bad. But it looks like this higher for longer is going to make that phenomenon worse.
So investors ought to be thinking, can the companies in my portfolio afford these higher rates?
That's it. And it's not just obviously the corporate market. It's also real estate. It's other markets. And that's, I think, one of the issues that's eventually going to put a dividing line between heavy borrowers and companies that don't borrow very much.
So give us some ideas of sectors, companies that you like in that environment.
Sure. So, we like high-quality companies. We like high-quality companies that have and can grow dividends. So, for example, Microsoft, great high-quality company. Yes, it's only a 1% dividend yield, but it's growing its dividend at about 6% per year, so certainly well ahead of inflation. Another company, Johnson & Johnson, same thing, high-quality company, 3% dividend yield, growing also at around 6% annually. We like Chevron. I think everyone's heard of Chevron. 3.6% dividend yield, growing its dividend a little more than 6%. And then McCormick Spice Company. Not well known, but everyone knows who they are. 2%. I think they're growing their dividend in excess of 8%.
And everyone's got a shelf full of those little red bottles, right?
That's right. And we love it when you throw it away before you use them all.
If you're not buying the individual securities, there's an ETF that'll do this as well, right?
That's right. So we like VIG is a high-quality dividend growers from Vanguard. It's pretty low, low cost. What else do we like? A lot of the small cap names. I think it's IJR. And here, I think we have to really make a distinction in small cap. It turns out that if you look at, most people look at the Russell 2000 as their small cap index.
Sure.
But what we have found was nearly a quarter of the Russell 2000 can't cover their interest payments with their current earnings.
Jim Grant calls those zombie companies.
That's what it is. And so if those debt service payments go up, it's just going to make things worse, certainly over time. What we would recommend is investors look at the S&P 600. As they construct the index, it's going to be comprising much higher quality companies, and so you avoid a lot of those pitfalls.
And small caps have had a tough run. I mean, that index has gone almost nowhere in 5 years. They look cheap. Maybe it's time.
They do look cheap, and the problem with small caps, at least relative to large, is really access to capital. So in an environment where not only are rates going up, but banks and other lenders are starting to tighten their lending standards, it would advantage the large cap, high quality companies where everyone's tripping over themselves, for example, to lend money to Apple.
Sure.
But if you're, AutoZone, they may not answer your calls.
All righty. Jack, thanks so much for coming by.
All right. Thank you, Jack.